Iron Financial, we don't chase the next big thing. We're not interested in market hype or the flavor of the month. No, our mission is to forge stronger portfolios, and we do that by finding companies that are the absolute bedrock of the economy. The kind of companies that are so fundamental, they're like the steel rebar holding up a skyscraper. You don't see it, but without it, the whole thing comes crashing down. We stress test these companies to see if they're really built of solid iron or if it's just a coat of paint. And today, VeriSign is going under the forge. Whoa, hold on a second. Before we fire up the forge, I need to know what we're looking at here. Are you about to break down another one of those high-flying, zero-profit tech darlings that's all sizzle and no steak? Or are we spending our time analyzing what's basically the internet's version of a slow, boring water utility? Because I, and everyone watching, need to know if we're gearing up for a high-risk play or a slow and steady grind. You know what? That's the perfect question. Is it boring, or is it secretly brilliant? That's the tension we're going to hammer out today. And here's our blueprint. First, we'll dig into its foundation, its role as the internet's bedrock. Then we're going to forge the financials from their latest Q1 2026 report and see if they can take the heat. After that, we'll stress test their growth. Is it real organic strength or just some AI-fueled illusion? Then we'll examine their pricing power, what we call the toll booth. And finally, we'll deliver our iron verdict. All right, no more talk. Let's get to it. Okay, to really get your head around the investment case for VeriSign, you have to understand the pure structural power of this business. This isn't just another company offering a service online. No, this company owns a piece of the internet's core geography. Let me put it this way. Forget about building a fancy skyscraper. VeriSign is the company that owns the land, the literal plot of land underneath every single skyscraper in the most valuable city in the world. Right, and what's so powerful about this is just how simple it is. VeriSign runs the official phone book for the most valuable digital real estate on earth, .com and .net. That means every single time a business, a brand, a creator, or just anyone wants to build something on a .com address, they have to ultimately pay VeriSign. They pay for the right to even exist in that directory. They are the final word, the authoritative, centralized gatekeeper. And this number right here just hammers home the sheer scale of that gate. 176.1 million. That's not just a statistic, that's a fortress wall built one domain at a time. And it's a record high, which tells you that even with all the new fancy domain extensions out there, the prime real estate, .com, is more valuable than ever. This is the foundation of their entire economic fortress. Every single one of those domains is a little annuity, a small stream of recurring cash flowing into their coffers year after year after year. Okay, I have to admit, that's a heavy-duty number, 29 years of 100% uptime. You can't argue with that. That is the kind of insane reliability that entire countries build their critical infrastructure on. It's durable, for sure. But here's my job. Does that rock-solid performance actually translate into rock-solid financials? Is this fortress just good at keeping people out, or is it actually generating wealth on the inside? Don't just tell me it's strong, show me the numbers that prove it. Exactly. A strong structure is completely useless if it's built on a weak financial foundation. So let's get our hands dirty. We're moving on to the hard data from their first quarter 2026 earnings report. This is where we see if those load-bearing numbers can actually carry the weight of this investment thesis. This is where the story ends and the reality begins. All right, now look closely at this because the real story isn't at the top. It's what happens as you go down the list. Revenue is up 6.6%. That's solid, steady growth. But then look at operating income. It's up 8.3%. That tells you right away that their profitability is actually growing faster than their sales. And then you get to the bottom line, the number that really matters. Diluted earnings per share is up a massive 11.4%. This isn't just a company getting bigger. This is a brutally efficient machine that's converting every new dollar of sales into an even bigger piece of pure profit for its owners. And this chart right here? This just paints the picture for you. This is the first massive pillar of a solid investment. You see that clear, steady, relentless upward march from just over 400 million to nearly 430 million in a single year. Look, this isn't that crazy, unpredictable up and down growth of a tech startup. This is the powerful, deliberate, reliable expansion you expect from a foundational piece of the economy. It's methodical, it's consistent, it's the kind of boring that builds real wealth. Okay, the numbers are solid. The CEO says they're solid. I get it. We all get it. But my job is to poke holes in this, and that phrase, steady growth in registrations, that's where I need to apply some serious pressure. Where is this growth really, truly coming from? Are we talking about real, lasting businesses setting up shop online? Or is this just a flood of low-quality, high-churn domains that are going to be gone in a year? In other words, is this growth being built on solid concrete or is it being built on sand? And that right there, that is the heart of the matter. It's why we have to move on to our next stress test. We are going to put these new registration numbers under the microscope and figure out if this growth is actually as durable as those financials make it look. Is this AI boom creating a new wave of lasting online businesses, or is it all just a beautiful mirage? So let's start with the bull case for this growth. Look at that number, 11.5 million new registrations in one quarter. That's the highest number they've posted in 5 years. And management is very clear about why. They say it's a combination of their own smart marketing and, more importantly, the explosion of AI tools that make it ridiculously easy for anybody to spin up a website. So, on the surface, this number screams robust, accelerating demand. And there it is. That's the billion-dollar question, isn't it? It's so easy to get hypnotized by a big, flashy number like 11.5 million. But let me tell you, not all growth is created equal. 1 million new customers who stick around for 10 years are worth infinitely more than 5 million who sign up for a cheap first year and then vanish. We have to look under the hood of this headline number and see if we're looking at a solid engine or just a revolving door. And here it is. This is the first real potential crack in that iron armor. On their own earnings call, management laid this out. Just look at that massive divide. For the new domains, the ones that make up that huge 11.5 million number, the renewal rate is only in the mid-40s. Let that sink in. More than half of these new registrations are gone within a year. That is a huge churn rate, and it's completely hidden by that big headline number. This right here is a potential structural weakness. See, I wouldn't call it a weakness. I'd call it a known variable in their business model, and it's one they're actively working on. This dynamic has always been there. New businesses and ideas fail. That's natural. But the absolutely critical point is on the right side of this slide. The domains that have already renewed at least once, the ones connected to established businesses, brands, and projects, they renew in the mid-80% range. That is the bedrock. The high-volume registrations are the top of the funnel, yes, but the real financial strength of this fortress is anchored by that incredibly sticky, established base. And this, right here, is the argument for how that crack gets patched up over time. The CEO's bet is that AI doesn't just make it easier to register a domain, it makes it easier to actually build something valuable with it. If AI tools lower the barrier to creating a real, functioning website that generates value, then it makes sense that more of those first-timers will survive past year one. This AI tailwind could be the very thing that improves the quality of new customers and starts to heal that renewal rate divide. So, we've established the foundation and we've put the growth numbers to the test. Now, let's talk about VeriSign's single greatest weapon. It's their most powerful, most undeniable structural advantage, their pricing power. This company, plain and simple, operates a toll booth on the busiest, most valuable highway on the entire internet. And it has the contractual right to raise the price of that toll whenever it wants. And this isn't some theoretical power. It's happening. It's on the calendar. On November 1st, 2026, the wholesale price for every single one of those .com domains is going up by 71 cents. This is the clearest sign you can get of an unbreachable economic moat. They don't have to ask for permission, they don't need to run a sale, they just announce it and boom, it becomes a direct, high-margin driver of future revenue. It's pure, raw pricing power in action. Now the obvious question is, well, won't they lose customers if they raise prices? That's always the risk, right? But that's where you have to do the math. As this slide shows, we're talking about an increase of less than 6 cents a month. 6 pennies! For any serious business, any creator, any organization that has built its brand on a .com address, that cost is a rounding error. It's nothing. The idea that a company would abandon its brand, its email, its entire digital identity just to save 6 cents a month is, well, it's pretty much zero. The risk is minimal. I'll agree the risk from that specific price hike is low, but you can't get tunnel vision. Even the strongest fortress in the world faces threats from the outside. And these risks here, they come directly from the company's own filings. What happens when ICANN, the internet's governing body, allows thousands of new domain endings, flooding the market with competition? What if a regulator in Washington or Brussels decides this monopoly has gotten too powerful? Or what if over time people just stop using traditional websites? These might be low-probability events today, but they are high-impact risks that you have to consider. The world around the fortress can always change. And that is the perfect way to move into our final analysis. We've laid out the foundation, we've forged the financials, we've stress-tested the growth, and we've measured the strength of that toll booth. Now it's time to put it all together and deliver the iron verdict. Is VeriSign truly an impenetrable fortress, or is it just a facade that's hiding some critical weaknesses? Okay, let's put it all on the scales. The bull case, the fortress, is built on some undeniable heavy-duty strengths. You've got a near monopoly on the internet's most important asset. You have proven contractual pricing power that drops straight to the bottom line. You have a history of consistent returns to shareholders, that insane reliability, and of course, the potential for AI to be a major growth driver. But the bear case, the cracks, they're just as real. You can't ignore them. That low first-time renewal rate is a persistent issue, a leaky bucket they constantly have to refill. The shadow of a regulator stepping in is always there. The threat from new domains could, over a long enough timeline, erode the dominance of .com. And, let's be honest, their most reliable growth lever is just raising prices, not necessarily true innovation. So, after weighing all of this, our verdict is this. While those cracks are real and absolutely require monitoring, the walls of this fortress are currently forged from solid steel. Its monopolistic power, combined with its incredible financial discipline, makes it a formidable structure in this market. So we've determined the fortress is strong today. That's the verdict. But the final, crucial question for any long-term investor is this. Is it built to last for the next decade? Or are those external pressures and internal cracks eventually going to cause that iron to rust? That's the question you have to weigh for your own portfolio. Because here at Iron Financial, our job is never done. We will keep testing for weakness because that is how you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.